All right. Welcome, everybody, to Finance 444. This is week 2. Appreciate you all being here, or appreciate you all participating in the class, I should say. I don't have anybody here for the live session. Of course, we're at 8:30 at night on a Monday. Again, must be a difficult time, but not an expectation of the class that you all come to the live session, just that you will definitely refer to and review the material from the live session at some point in the recorded session format. So, looked like it was a pretty decent week 1. I am missing some work from a handful of you. I hope that's because you just had a busy week and that you will get on track as soon as possible with your work. For those of you who find yourself behind, don't despair, don't give up. Obviously, you've got plenty of time to get everything in. Just as a reminder, I accept everything up until the end. Having said that, you don't get full credit for late work, but you do get most of the credit. So if you're looking to pass the class, the way that you pass the class is you get your work in. All right, so last week we talked about some of the later chapters in the textbook. Today we're going to circle back and look at some of the earlier chapters in the textbook from 2 different parts. Part 1, or chapters 1 through 3 in the e-text, are some different subjects. The one we're going to cover today in chapter 3 is taxes. Part 2 is about money management. We're going to talk a little bit about banking and basically managing your day-to-day finances and what options and information are associated with that. So I would encourage you to read chapters 3 and 4 in the ebook. The questions on the test will come from those chapters. We will spend the last few minutes tonight, as we always do, talking about what will be on the test this week. This week's test is only 10 questions. Some of them are from last week's material, so technically it is comprehensive from weeks 1 and 2, but most of the material is from chapters 3 and 4. So you've got 4 chapters of content to refer to for the test this week, but as I always do, I'll give you the topics that you need to know for the test before we get to it. And we'll spend the last few minutes doing that. All multiple choice, pretty straightforward, so it shouldn't be too difficult of a test. We'll give you the topics that you need to know so that you can go look for them, study them, and make sure that you're ready come test time this week. As far as the discussion board, we've got a discussion board that's about types of orders as far as stock ordering. Market orders, limit orders, and stop loss orders. There are 3 different kinds. We'll want you to research those out, make sure you understand the basic differences between them, and then what type of order you would prefer to use just as an opinion. Now, the discussion board will get very, very boring for all of us if after the first couple people write their discussion board comments, we've got definitions of those 3 ordering types, and there's not much more to cover other than opinions. So I would encourage you to supplement the content that you have in your main post with some of the opinions and perspective and information from chapters 3 and 4, whether or not it be about taxes, avoiding, or evasion. So avoiding's the very legal and very important thing to do regarding taxes. Evasion is the illegal and criminal thing that you can do related to your taxes that gets you in trouble and can end you up in jail. So every single state that you might live in has folks who are in jail because of tax evasion and because of them trying to manipulate their taxes to pay less. Many times it comes in conjunction with other areas where they were breaking the law, and sometimes it's tax evasion that ends up landing them in jail even though they were doing many illegal things. That's just the one thing that the courts could get them on and put them in jail on. So if you'd like to, for this week, you could do a quick research for your state. Just type into Google tax evasion cases and then the name of your state, and you'll probably find some recent news regarding some folks in your state that have tried to evade taxes but have been caught. Okay? There's been high-profile people throughout history in this country, at least in the United States, politicians, famous artists, famous musicians, famous actors, actresses, folks all across all aspects of life that have tried to evade taxes and got in trouble. So anyway, that might be an interesting little side note to do a little bit of research on as we're trying to add a little bit of content to this week's main post. Still needs to be a substantial post. We need to, carefully answer, those three different order types as far as, what they are and then which one we would prefer. But that might take one paragraph, and you got to have 2 to 3 paragraphs and some citations. So I would encourage you to use the content from the chapters this week to start, giving some feedback on either your own tax preparation or tax experiences, what you prefer or don't like about doing taxes each year, what your experience has been as far as getting returns or having to pay. Whatever you'd like to share, you could, or you could, like I say, do some research about your state and some folks who have gotten in trouble because of tax evasion. Then also the next chapter talking about some basics of banking. You could also talk about which bank you use, what your experience has been, what you like, what you dislike, if you'd like to, and that could also add or supplement to the content that you provide this week on the board for your main post. Okay, so that's this week's discussion board. Stay consistent, get that done. Make sure that you get your checkpoints, stay consistent with your checkpoints. We also have, of course, an assignment this week. It's from the end of chapter 4, so it's about the money management chapter. It's from the money management chapter. And let me just pull it up right now as I'm talking about it. It's basically a case study about Carl and Elaine Blankenship. So if you're reading about the Blankenships, when you're looking for your assignments at the end of chapter 4 in the financial planning exercises or problems, and it's number 9, and it basically says this couple earns $82,000 a year after taxes. So they've already paid their taxes. They have about $82,000 of take home, or about $7,000 a month. Through an inheritance and some wise investing, they have an investment portfolio of about $150,000. Okay, so they make pretty good money. They have some pretty good investments. And then there are parts A, B, and C that you need to answer in the format of short answers to those questions. And the first question is, how much of their annual income do you recommend that they hold in some form of liquid savings as a reserve? So what you would do is you'd want to go to chapter 4 and find in chapter 4 where it talks about how much of your income is suggested to have in liquid reserves or liquid savings, and then times that percentage by their $82,000 a year, and that could be a good answer for that. Or if you've researched and found a different figure that you like, obviously you're welcome to use that. Most times we hear in the financial planning industry 3 months, 6 months, or 12 months, depending on who you talk to, of emergency reserves. So if you make $82,000 a year, some people would say that you need $82,000 worth of reserves. That's on the more aggressive side. But most people would be somewhere in the neighborhood of 20 to 40, right? A quarter to half of your annual income set aside for emergencies. Okay. There are a lot of other factors that play into it. Do you have access to lines of credit, other forms of credit at a low interest rate? Do you have cash value in insurance policies? Do you have savings that are liquid somewhere else, or investments that are liquid? Those could act as part of your reserves. And then the other thing that is always important to consider is that $82,000, is it pension income that will never go away for life guaranteed, or is it job income that, with a change of a job or unemployment could go away very quickly? Those kinds of things play into how much you would want as an emergency reserve. So those are some of the things that you could think about and consider for part A. Part B, it says how much of their investment portfolio to recommend they hold in savings and other short-term investment vehicles. So they've got liquid savings for reserves, and then how much more of their investment portfolio do you recommend they hold in savings or short-term investment vehicles, and why, basically. So give a number and then explain it. There is no right or wrong answer. There are people who are very aggressive about how little they save and keep in liquid reserves, and then there are people that I work with that are very, very conservative about how much they save in reserves. and they save a lot to make sure that they always have plenty, even more than they need probably at any given point, in liquid savings or liquid reserves or savings or conservative parts of an investment portfolio. Now, if you already have significant liquid reserves, right, for emergencies, then within your investment portfolio, you may want to minimize the amount of cash that you hold. Why might you want to minimize the amount of cash? Because on a relative basis to bonds, stocks, mutual funds, any other types of investing, cash, any other type of investing, cash pays very little, right? So if you were to go into your bank and find out how much a money market or a savings account pays right now, you may be surprised at how little they pay. The average savings account right now in the United States pays about 30 basis points, or 0.3%. The average savings account is paying, a third of a percent is all for you to have your money there. CDs are very low. Money markets within investment programs are very low. So this is just your safe money part, and it's the part that's not going to get a whole lot of interest. So keep that in mind when you talk about how much of their investment portfolio they should have in cash. Now, one of the things that we don't know about Carly and Elaine, at least from this section on part 9, is how old they are, right? If they were older, maybe we might need more in cash, right? Or more in conservative instruments. If they're younger, we might need less. Now, some of you might make a guess based on their names, Carl and Elaine, that they're either middle-aged or older, but we never know, right? And it doesn't tell us, at least in this part of it. So anyway, you could make up a scenario, come up with an age that you think they are, and then determine how much you think they should have in cash as part of their investment portfolio. Again, knowing that that cash portion is not going to get any interest, or very, very little. And then in C, it says how much in total should they hold in short-term liquid assets. And this seems kind of, seems like we're belaboring the same, thing over and over again. But how much of their savings do you feel like they should have liquid in total, across everything, across both their investment portfolio and just in the bank? And this is an interesting question, because when somebody inherits, for example, $1 million from family, or wins $1 million from the lottery, maybe you should think in terms of, okay, so how much should that money should be safe money? How much of it should be just in liquid savings for things that we might need to purchase, or things that might need to happen in case of emergency, in case of a job loss, or something like that? And then how much beyond that can we actually invest more aggressively, and why? Why is that? Okay? So if you read Chapter 4, there'll be a lot of feedback that Chapter 4 gives you regarding, situations like that, and it'll give you some rationale on why you make decisions when it comes to your investment portfolios, on how much should be in cash, how much should be liquid, how much should be there for emergencies, versus how much is there for the long term to try to grow your assets and try to gain more, right? And have your investments grow. Okay, so that's the assignment this week. Make sure that it's a decent sized page and a half, 2 pages worth of writing, answering all 3 of those scenarios, those short answer questions based on the case study. All right, so that's our assignment for this week. As we mentioned, the assessment's 10 questions. We'll go over those 10 questions at the end of class. The discussion board we already talked about is pretty straightforward. It's about ways to order when you're ordering or trading in or out of stocks or ETFs. And so, as I mentioned, I've added a few extra things that you could add to the content of your main post, just to get to the 2 to 3 paragraphs, because this week's question, as far as the discussion board is concerned, is pretty straightforward, pretty simple, and won't take a lot. And we're going to be reading from all our peers almost the exact same information, the definition of those 3 trades, and then a little bit about their preference or their opinion as far as which one we should use. So there's some other things you could do to that to add to it. All right, so now I want to cover chapters 3 and 4, a little bit from both chapters. We've got a little bit of time to go through quite a few slides tonight, and then we'll spend the last 5 or 10 minutes talking about the 10 questions that are on the test. Before we get to that, I do want to just mention that I will be grading soon the work from week 1. And so over the next 24 hours, sometime tonight or tomorrow morning, you will see grading. You will also see feedback, and I will be encouraging some of you to complete some additional work or edit or resubmit for additional credit. And that's something you're always welcome to do. If you have any questions or concerns about the grading, just get in touch with me. And send me an email, give me a call, whatever you want to do to be in touch so we can discuss and give you some feedback. Okay, we're ready for Chapter 3. So as I mentioned before, Chapter 3 tonight is about your taxes. Chapter 4 is about some cash management, basic banking principles. And so what we want to do is cover the taxation part first. Try to make it interesting, although taxation is not, well, for some of you, maybe it is interesting, and I don't want to offend you, but for most people, taxation is not that interesting, so I'll try not to put you to sleep with too much, digging too far into the weeds or getting too specific about taxes. But basically, the IRS is the Internal Revenue Service. We know that. They are the ones responsible for both administering and enforcing federal tax laws. Federal tax laws, not state tax laws, not city tax laws, not county tax laws. We're getting taxed by a lot of different entities at any given point, between gas tax, between property tax, between sales tax, all these different taxes that we pay on. We're getting taxed by a lot of different entities. When we talk about the Internal Revenue Service or the IRS, we're only talking about an entity that looks at federal taxes, okay? There are other bodies, other regulatory bodies that take care of local and state and community and county taxes, okay? Typical American family pays more of a third of their gross income in various taxes, not just federal income taxes, which is the big one that we always think about, but think of all the other taxes that we're paying. There's a tax on almost everything. Next time you think that you're not paying much in tax, look at your cell phone bill or other utilities that you pay, or look at your property taxes, or look at your sales taxes that you pay, or look at the gas taxes that you pay. There's taxes on almost everything. Go rent a hotel room for a night. You've got all kinds of taxes there. There are taxes on almost everything, and a lot of things you're going to get taxed twice, right? You're going to get taxed if you own a business, then you'll get taxed on your personal income. Then after you've already been taxed on your personal income, you're going to be taxed on the things you use and the things you have, like your house and different property. And when you go to sell property, as far as investments are concerned, you're taxed. So there's all kinds of different taxes, and there are basically two different ways, or three different ways, I should say, basic ways that taxes work. One is progressive, one is flat, and one is regressive. Progressive taxes are taxes that the more you make, or the larger you realize some kind of gain or income, the more percentage tax that you pay. So how does that work? Well, it's like our federal income tax brackets. If you make very little, you pay a low interest, you pay a low percentage. For example, if you're in the lowest bracket, you pay 15%. And if you make under like $30,000 a year as a household, you don't pay any in net taxes as far as federal taxes are concerned. The second type of taxation is flat tax. That's just a percentage that is the same no matter how much you make, so that's pretty straightforward. And then the final is a regressive tax. And how a regressive tax works is that the lower your income, the more it hurts you. So let's just take, for example, food taxes, okay, sales taxes. When I go to the store, I pay 6.235%, something like that here in the state of Utah on goods that I buy. And if, as a percentage of my income, food represents 10% of my overall income, then I'm paying tax on that much when I go and buy my groceries. The lower income that I am, so the lower my income, the closer I get to poverty level, the more of a percentage of my income that I use for food. And because it's more of a percentage of my income that I spend on food, I am actually paying more, not in dollar amount, but on a percentage basis, on a relative percentage basis, I'm actually paying more in taxes than somebody who's wealthy. So that's why it's considered a regressive tax. It actually hurts people on a relative basis more that make less money, because everybody needs food, right? And basically you're taxing the people that are at the lowest tax brackets the most, not because the percentage goes up, but because of the percentage of the money that they spend for that particular item is higher. Okay? So a rich person might spend 1% of all their income on food. So that's the only amount that they're going, it might be a big number, but that's the only amount that they're going to be paying sales tax on, where a poor person might spend 30% of their money on food. And so that's the amount that they're going to pay the sales tax on. So it's not that they pay a bigger dollar amount, but on a relative percentage basis, they're paying out more of their income in sales taxes than a rich person would. Okay? So the book talks about this, and basically the important thing to understand is that regressive taxes are looked at very poorly because they hurt poor people, and progressive taxes are looked at very favorably because they tax richer people more. Okay? Obviously, rich people would rather have flat taxes where they don't have to pay more if they make more, right? They're going to pay more on a dollar basis, but they don't want to have to pay more on a percentage basis. And of course, the opposite is true of the middle class and the poor. They would say, well, if you are rich, you should pay more as a percentage, not only as an absolute dollar amount, but as a percentage of an amount. So when people when every Republican over the past, 30 years has run a campaign on going to more of a flat tax, that's very popular among middle class, upper middle class to wealthy. And then lower class folks and poor people many times prefer the idea of a marginal tax rate like we have, a progressive tax rate, where the more you make, the higher rate you pay. Okay? And there's a lot of exceptions, of course, to both sides of that. I'm just generally grouping people in, and of course, we know there are exceptions on both sides of that. But difference between progressive and regressive taxes, and then, of course, flat taxes in between. All right, you've got all kinds of different filing status categories, and with federal taxes, that does change what you're going to pay. You've got married and single are the two most common ones. You can go through the rest if you'd like. Your take-home pay basically is what you actually get after you pay all your taxes. Federal, state, local, FICA, which is of course, your insurance programs like Social Security, and Medicare, which is a big part of your taxes, actually. If you look at your breakout of your statement, you'll have income taxes, which is usually the biggest chunk, federal income taxes, but you'll also have a segment for Medicare and a segment for Social Security and your employer's segment for Social Security, and then you'll also have a state income tax in most states. So some of you don't have state income tax, but most states do. And those states that don't have income taxes, most of them have higher property taxes. The ones that don't have high property taxes usually have higher sales taxes or income taxes. So between sales tax, state income tax, and property taxes, those three, whichever one your state is the most favorable in, it usually is less favorable in those other two categories. Okay? So you kind of give one place up, and then you end up paying more in another. You've got some states that are a little bit of an exception. States like Alaska and Nevada are kind of an exception. Nevada has a lot of gambling taxation that happens that helps offset, so that they can have lower taxes overall. And then the state of Alaska, of course, has a lot of oil and low population that they get royalties on, and so they have lower overall taxation because of that as well. So some states actually do have overall lower taxation, even when you account for all three of those, property, sales, and income, and kind of average them out together for the average household. But most states, if you have one that's lower, you're going to make up for it somewhere else in one that's much higher. Okay? You got three different types of income when it comes to taxation. So we talked about how we've got income taxes, right? But we also have different types of taxation for the income that we get. We have our active income, which is our W-2, the wages that we get for putting in our time at work. We've got portfolio income, which would be something like dividends from a stock investment or from bonds. And then we have passive income, what's called passive income. And this comes from royalties, real estate, limited partnerships. So if I own a rental property, that income that I get from that is considered passive income. Now, what is interesting about and why they group them like that is because losses in one of them don't, as a general rule, offset all the losses in another, or all the gains in another. So if I have active income of $50,000, but I have passive losses of $50,000, I can't write off all my active income because of my passive losses. There are certain amounts, and they're very low, that can go across these different income buckets, to help offset gains in a different place if you have losses. But most of the losses in one of these buckets have to stay in that bucket to offset gains within that certain bucket. Okay. Gross income is everything and includes a lot of stuff. It's a comprehensive list here. We've got alimony that some people don't think is included. Lottery winnings, gambling winnings, those prizes, those are all included. Commissions, tips, all that's part of your gross income. So you take your gross income, you adjust it, okay? So you take out tax deductible expenses, and then you get to what's called your AGI, or adjusted gross income, which is the income that you start to take off credits from and other deductions. So you have your adjusted gross income, you itemize deductions, or you take your exemption, one or the other, and that gets you to your taxable income. Take your taxable income, you take out credits, and then you get to your total taxable liability. Okay, so a lot of steps, but it really is pretty straightforward, especially when it comes to a situation where you've got a pretty straightforward situation, like you've just got some W-2 income each year, you don't have a lot of expenses or write-offs. That ends up being a pretty simple filing. That's why you've got a lot of people on street corners that can file taxes for you, that have a few hours of training, and all of a sudden they're tax professionals that can do your taxes for you. It's because it's not that complicated, and there's a lot of very good software to help. Okay. So what are we talking about when we talk about capital gains? This is any piece of property or investment that you've held and then you've sold at a gain. Okay, you could have a loss, but in most cases you've got a gain that you're reporting. So let's say I buy a car this month and 6 months later I sell it. If I sell it for more than I bought it for, the difference of what I bought it for and what I sold it for is considered a capital gain. In this case, because it's under 12 months, it's considered a short-term capital gain and taxed at my normal income tax rates. So it just adds to my income as far as taxes are concerned. If I had held it longer than 12 months, then it's considered a long-term capital gain, and it's taxed at long-term capital gains rates, which the rates on long-term capital gains go 0, 10, 15, and 20. So you can see those rates, or at least you should understand that those rates are much lower than the normal income tax rates. Income tax rates can go all the way up as high as 39.6%, or 40% basically of your income can go to just federal taxes. That's before FICA, that's before Medicare, that's before state income taxes. So you can end up paying about half your income or more in taxes and total taxes if you're making good money. And capital gains, if they're short-term, are lumped in and taxed at that high rate. If they're long-term, more than 12 months, then they are shorter. And you can see here are the brackets. These are out of date. Capital gains, you can see it says 0 and 10, or excuse me, 0 and 15%, but reality is, so that's the 2010 and the tax back in 2010, so that bracket has changed a little bit. Now you've got 0, 15, and 20, as I mentioned before. But if you hold it less than 12 months, it's at your normal bracket. Now we have a tax bracket that's at 39.6%, which is a little higher than it used to be back in 2010. Okay. Got different adjustments to gross income, like IRA contributions, alimony paid, moving expenses. You got some of these deductions that adjust. Then you've got a standard deduction, which the new tax legislation that is being proposed by the Republican Party right now in Congress is to double the average standard deduction for American citizens. So that standard deduction would go for a household from about $10,000, $12,000 up to about $20,000+, which would just mean that fewer people would itemize deductions for charitable giving and for their interest rate deduction on their home, because more people would just take the standard deduction instead of having to itemize. And the more people that take a standard deduction, the more simplified the tax filing is, right? Because if you don't have to itemize deductions, that's one less thing that you have to figure out on your taxes. Most common standard itemized deductions are mortgage interest and charitable contributions. So if you pay like a tithing to your church, or if you just donate to a college or to a hospital or a charity of your choice, all those charities that you donate to in a year, you add that dollar amount up, and that's something that you can deduct from your taxes in most cases. as well as, like I say, mortgage interest. Another item is taxes that you paid to both state and local entities. That's another very common itemized deduction. All right. Get credits for different things, but there are not very many of them. And then you have brackets. And these brackets are very out of date. As I mentioned, the numbers, especially for those that earn more, is much higher. But it gives you an idea of how a progressive tax rate works when it comes to the federal income taxes. So which is better, credits or deductions? Credits are a dollar for dollar reduction in the amount of tax you're going to have to pay. Deductions are not a dollar for dollar reduction in the amount you pay. They're a dollar for dollar reduction in the amount you earned. So if your taxes are at 30%, a credit would save you dollar for dollar off of your taxes, right? 100% reduction in tax. A deduction would reduce your taxes by about a third, right? Because they're going to reduce your adjusted gross income, and then you're going to pay 30% on whatever that dollar amount was, that lesser dollar amount was. Okay, so something important to understand, that credits are much more valuable than deductions. When somebody says, well, don't worry about it, and you should do this because you can deduct it, that doesn't mean that you're going to save dollar for dollar the money that you put in as a deductible, whatever it is, you know, for expenses or for an IRA or something like that. But it does mean you're going to save about, you know, the percentage that you pay in taxes on the amount that you deducted. Okay, so if I make a $5,000, let's say it's a $4,000 contribution to an IRA and I pay 25% in taxes, that means I'll save about $1,000 in tax. Okay, so my rate was 25%. I deducted $4,000. That means I'll basically save about 25% of that amount that I deducted, or about $1,000. I still meet with a lot of business owners and a lot of individuals when they talk about their taxes. They say, well, it's fine because I can deduct that, or I'm going to hurry and go buy a Hummer because I can deduct that. That's fine if you already needed or wanted whatever it is that you're going to deduct, but it's not fine if you didn't, if you're just coming up with stuff to deduct, because again, your deductions are only equal to the percentage that you're paying in taxes. So if you're paying 20 or 30% in taxes and you go buy a $60,000 Hummer, you're only going to save about $15,000 in taxes, which is a lot of money, but you're still going to be out $45,000, you know, for the Hummer, right? So you save some money in tax. So if you already wanted the Hummer, great. But if you didn't, and you're just using it as a tax deduction, that's the only reason you got it, then you're just spending money, okay? So lots of different tax forms. The 1040EZ is the one that's most common, okay? You can see why here. Don't have a lot of claims or adjustments, income under 100,000, age under 65, and it's just really straightforward, okay? The problem is most people don't know about the rules of a 1040EZ, and so because they don't know if they can use it or not, they still end up paying somebody else to help them out. Okay. So should you do it yourself? Should you get help? Computer programs out there are very helpful, but just always remember, no matter what you do, computer program, corner office guy, CPA, do it yourself, whatever you end up doing, know that you yourself are the one that's ultimately responsible for it, not the person who helped you. So understanding some basics of tax is helpful, because in the end, you're the one that's liable, not the person that helped you, okay, or not the software that helped you. Okay, avoidance is legal, evasion is not. We talked about that a little bit earlier on tonight. It's perfectly fine to try to avoid taxes legally. It's not fine to try to evade taxes illegally, meaning that you basically lie in order to not have to be taxed. Okay, that's evasion. That's what ends people up in jail sometimes. All right. Enough about tax. Let's look at some basic cash management issues. And when we talk about basic cash management issues, you can understand that a lot of this comes down to some banking products. And when I say banking products, I'm speaking generally. It could be credit unions. It could be, you know, savings and loan. It could be your local corner office financial institution, you know, in your neighborhood. I understand that, you know, people bank differently. A lot of times I'll refer to it as banking because the standard out there is what credit unions and banks do as far as checking and savings and money market, CDs. Those are the types of instruments that are kind of the standard. And then things like payday loans, title loans, pawn shop loans, those are considered, cash money, hard money loans. Those are all considered alternative, banking. And I realize they're widespread and a lot of people use them and appreciate them, but those tools usually come with a little bit more expense associated with them than the traditional banking products at a credit union or bank, right? Okay, so let's talk about managing your cash and savings real quick here. And then we will, after that, we will spend the last few minutes like we've talked about going to the test. Now, what is the role of cash management? Why do we even talk about cash management when it comes to our personal financial planning? And I guess for those of you who are studying finance and are going to take some corporate finance classes, just know that when we talk about working capital for a business, it's the exact same conversation we're talking about when we talk about liquid cash savings for an individual. Businesses and individuals need working capital. We need liquid reserves to take care of our basic necessities as far as our ins and outs, our puts and takes as far as our money is concerned, right? We all have expenses. We all hopefully have some income. So we have flows in and we have flows out, and the working capital that we need, or the liquid savings that we need, or liquid assets that we need, are what's going to cover the expenses that we have that come sometimes on a daily basis, right? So what are liquid assets? They're the assets that we can get to pay bills, to do different things with our money without expense and without any loss in value, and they're very convenient and easy to get at. So what's an example of this? Well, cash, right? Cash is easy to get. We don't have to worry about it going down in value from day to day, although over time it does reduce in value because of inflation. But day to day, it's not going to change. So if I have $1 today, I got $1 tomorrow, it's a dollar bill, it's worth the same approximately. I realize generally no over long periods of time, but day to day, yes, it's worth about the same, right? My same dollar can buy about what it could yesterday. If I go take that dollar and invest in a pretty rock, and then I need the money, there's a chance a couple different things could happen. I might not be able to sell that rock. Maybe nobody wants to buy it. I was the only one that thought it was a pretty rock, and so I can't sell it. Or I can sell it, but I might get less than my dollar, right? Because somebody might not value it as much as I can, as much as I did. So that's kind of an extreme example. We're not going out and buying rocks, I understand. But we are doing things sometimes with our money that we think, oh, well, that's fine because I can just get my money back if I ever need it. I'll buy this piece of art, or I'll buy a car, or I'll buy something. And then if I need some money, I'll just sell it, or I'll get a loan off of it or something like that. No big deal. And a lot of times what we find is it is a big deal. It has gone down in value, or there's some costs associated with getting it or money. So it's not really a liquid asset. So some examples of really liquid assets: cash, we already talked about, checking accounts, savings accounts, money market, deposit accounts, money market mutual funds, CDs, treasury bills, and treasury bonds. These are all instruments that we can get cash quickly, that are safe, that don't go up and down in value, they don't fluctuate in value, and so they're considered liquid assets. Okay, got a lot of different financial products out there. We've got different institutions that take care of them. Most people, again, I realize there's lots of other institutions out there that can work with your money, but traditionally for money management, we're dealing with a bank or a credit union. Okay, and we're not going to spend time trying to decide whether or not one's better than the other. They both have their advantages. They both have their disadvantages. A lot of times rates are better on a credit union account. A lot of times technology and scope and scale and abilities are superior from a bank. So for example, large companies, large Fortune 500 companies will almost always work with a big bank. And a lot of times individual households will work with a credit union because they don't need the capacity and services and products that sometimes a big business does internationally, for example. But they do like, service and returns and rates that are really competitive. And a lot of times credit unions and local banks can do that. Community banks can do that. So just depends on what you're looking for, what types of accounts you want, and which is better. Just preferences, and then also in your geography where you're located, what options you have. Some rural places in the United States only have 1 or 2 options that are close and local. So that kind of helps you make your decision pretty quick. Most metropolitan areas have lots and lots of options, right? I could bank in Utah County at 25, 30 different places. They're not all really close to my house, but somewhere within 15 minutes, I've got 20 different banks or credit unions that I could choose from. Okay, so it just depends on where you're at. First of all, your geography, and then also what your preferences are and what types of products you're looking for. Different types of organizations, but S&Ls have almost all gone out of business in the early 90s, so I don't even know why we talk about them a lot. Big commercial banks, your city banks, Bank of America, Chase, those are all big commercial banks. And you've got savings banks that are smaller, usually like M&T and others. They say located primarily in New England, but basically S&Ls and savings banks are the exception. Big commercial banks and credit unions are the ones we're familiar with, right? Wells Fargo, Chase, Bank of America, Citi, those are all big. KeyBank, US Bank, those are all big commercial banks. And then you've got credit unions in Utah like Mountain America, Utah Community Credit Union, UCCU, America First, Nebo Credit Union, Beehive Credit Union, or at least was Beehive Credit Union. Now I think it's like Safety Security First Credit Union, something like that. So there's a lot of different options with credit unions and big commercial banks almost everywhere in the country. Big commercial banks have FDIC, or Federal Depository Insurance, up to $250,000. Okay, so in 2010 it says that the Consumer Reform and Protection Act of 2010 increased the maximum deposit insurance from $100,000 to $250,000. So hopefully you all were aware of that. Hopefully you all have large deposit different places. I don't have enough to make this this impactful, but a lot of my clients do, and it's important to some people to have their entire balance FDIC insured. Well, that FDIC limit has gone up from $100,000, which is where it used to be, up to $250,000. So a lot of people, if they had $1 million, they'd split it between 10 different banks just to make sure that they had FDIC coverage. Now, $250,000, you only have to have 4 different banks to get that $250,000, or just different registrations at the same bank to get that full amount FDIC insured. NCUA is very similar to FDIC. It's just the insurance that exists at a credit union instead of a bank. All right, so checking accounts are considered demand deposits and savings accounts are considered time deposits. Why? Because checking accounts are demand deposits that just need to come out. They're the put and take account. They're the account that we're not really expecting interest on. We're not going to hold our deposits there a long time. We're going to use that money for the necessities of life, for something, right? We're going to write checks off it. We're going to use it. It's meant to be a high volume account. Then our savings account is meant to be a time account, meaning money's going to sit there for a while, and because it's going to sit there for a while, we're going to get paid some interest on it, but the bank's not going to expect it to be a high volume account. You're not going to be making a lot of transfers from it. You're not going to be writing checks off of it. Most savings accounts don't have checks. And so what happens is a bank, they have demand deposits and checking accounts. They have this, they lump all their account holders together and they categorize them, and they say, okay, all the demand accounts, we can only use a certain percentage of that money because we expect most of it to move, to change, to fluctuate, to be spent, right? That money's going to be coming and going from those accounts. There's high velocity in those accounts is what they'd refer to it as. In a savings account, there's low velocity as a general rule. And because there's low velocity, they can lend to their customers a lot more as a percentage of savings accounts than they can as a percentage of checking accounts. Okay, so it means a lot more to a bank than it does to you and I anymore, because of online banking. Difference between a checking account and a savings account is, it's not nearly as important. Most of us get paid into a checking account. Most of us pay our bills out of a checking account, and then we've got a savings account that we can transfer back and forth from online, even really easily. That usually gets a little bit of interest associated, although interest rates are very, very low right now. Different kinds of checking accounts. I'm not going to go into that. There's different types of investment, in savings accounts. Money market accounts at a bank are considered MMDAs. Money market accounts at an investment company like, if I were to invest with like Fidelity in their money market account, that would be usually a money market mutual fund. And again, money market mutual funds and money market deposit accounts are both very, very low interest paying accounts right now. But historically, these two would usually be higher than savings accounts. But right now, there aren't very many money market accounts, either mutual funds or demand deposits, deposit accounts that are very high, just because interest rates are so low. Okay. As far as banking is concerned, you've got what's called EFTs, or electronic funds transfer systems, between all these different places. Anymore, it's mostly done through online banking, but the banks themselves use the same system to electronically transfer their assets from one account to another to make sure that they've always got money available for you if you ever needed to use it. 1978, we get some more regulations on that. You can get a safety deposit box or trust services at a bank. Banks, usually the older ones, will have a vault and they'll have boxes that are keyed inside. If you pay on an annual basis, or if you're a really good customer, they'll give it to you for free. But it's a nice place to keep documents, coins, collectibles that are small, right? Somewhere that's fireproof, that's safe, that's secure, that might be a better place than at your house under the bed, right? And then trust services to be able to manage your estate when you pass away, different things like that. Different kinds of issues on checking accounts. These are all things that we should be aware of. We don't want overdraft charges or problems, costs associated with checking accounts, something we should understand before we open an account. And we should check fees from one bank to another and find a bank or credit union that's not going to charge us very much to have an account, either very much or anything, right? Used to be in the day that everybody could get a free account. That's less common now. If you're a really good customer of the bank, you'll have a free account. If you are a new customer of the bank or a small customer of the bank, many times there'll be some charges associated with having that account and having the convenience of having an account. So just be aware of that and maybe shop around if you're in a situation where you're getting charged, because there may be an option out there that's less expensive or free. Or it may just be that you're new and have a small account, and so there will be some nominal charges associated with your account. Okay? All right. So how can you establish a savings program with your checking account? Well, every single bank will allow you to automatically set up a reoccurring automatic transfer from wherever you get paid, direct deposit to your checking account, into a savings account. So if you get paid once a month, you can set up an automatic transfer once a month as soon as you get paid to transfer over to your savings account. Okay. Now, for some people, this works great. For other people, if they can see their savings account every time they log into their online banking, and if it's just a click of a button to transfer it back to their checking, that's never going to work. That's not going to be a sustainable thing for them to do. And so many times what they'll do is they will open the savings account at a separate institution, like an online bank, like Ally Bank or American Express, which I know is a credit card company, but also has a banking arm. There's these different Synchrony Bank. There's these different banks online that are very easy to open, very easy to transfer money back and forth, and they'll set up an automatic transfer to one of those banks that's kind of out of sight, out of mind. Still FDIC insured, still a legitimate bank, easy to transfer the money back if they have to, but a separate place they have to log into. And because it's out of sight, out of mind, just the psychology of it is that it's maybe easier to keep that money together instead of spending it when whatever comes up. So we're at the store, something goes on sale, we don't have money in our checking account, but we know we have money in our savings account. So just from our phone right there, we can transfer it from our savings to our checking and blow the money on something that we didn't need but wanted, right? Where if it's out of sight, out of mind at a bank that we don't readily look at all the time, sometimes that helps us to stay more consistent and stay more disciplined about keeping that reserve or that savings account together. Okay. Of course, we all want to earn interest on our money, especially in our savings accounts. Savings accounts right now pay very little. They used to pay 3, 4, 5% in a money market account or a high yield savings account, but now, like I say, national average is less than 1%. There are some online bank accounts and savings accounts that pay closer to 1.25% right now, which is better than 1/3 of a percent. The problem is when you're talking about a small balance, getting 1% versus getting 0.3% might not be enough of a difference to hassle with it. If you're talking about bigger amounts, and bigger amounts are relative, just depends on your situation, who you are, and how much you have. It might make all the sense in the world to open a different account just for a little bit more interest, because every little bit, is going to pay you quite a bit more if it's a bigger balance. And it might be worth the effort and hassle to open an account just to be able to get that higher interest rate. Okay? All right. Enough about banking. Compounding rates, effective rates, simple interest rates, those are all things that you can see within the text here in Chapter 4 this week. Okay, let's talk about the test here real quick here at the end so that you will feel ready for the questions that will be on it. All right, so we have 10 questions, as I mentioned before, all multiple choice. And let me start right into it. So question 1 on the test is asking you what a tax audit is. What is a tax audit? So just make sure you understand what the definition of a tax audit, that would be from Chapter 3. Make sure you understand what a tax credit is. Remember, there's a difference between a tax deduction and a tax credit. What is a tax credit? If you can define it and how it works with your taxes, how it interacts with your tax, you'll get number 2 right on the test. Number 3 on the test, difference between avoidance and evasion. What is avoidance? What is evasion? We've talked about that from a tax planning standpoint. What is avoidance? What is evasion? One of them is perfectly legal and fine, and I would encourage you to consider it, and the other one is illegal and not okay, right? You're lying, basically. Number 4 on your test is capital gains, and specifically a question about capital gains as it pertains to your personal residence. The rule about capital gains as it pertains to your personal residence. There's a rule that basically says if you're in your house for a certain amount of time, you don't pay capital gains on the gain when you go to sell your personal residence. What is that rule? What are the years that you have to be in the house? What are the guidelines on that to not have to pay taxes? Number 5 on the test, why do investors use mutual funds? This is a review question from last week. What are the reasons why investors use mutual funds? Number 6 on the test, stock profitability is measured by what? So this is also a repeat, or not a repeat, but a question that is more comprehensive. It's from last week. What ratio is measured often, is used to measure stock profitability? What ratio is often used to measure stock profitability? Okay. Number 7 on the test wants to know if you understand how dividends from stocks will be taxed. Okay, and specifically stock dividends. This is a repeat question from last week. Stock dividends, how are they taxed? Not cash dividends, but stock dividends. How are they taxed? Number 8 on the test, which one do you receive interest on? Savings or checking? And if you do receive interest on your checking, is it more or less usually than a savings account or a money market account? That is straight out of Chapter 4 that we were just barely reviewing the slides from. Pretty straightforward. Number 9, same thing. Difference between checking, savings, money market, and CDs. Which one pays us the highest? Number 10, when it comes to interest that's lower, usually that has to do with either longer-term deposits or shorter-term deposits. So if you're getting a low interest rate, is that usually because it's a shorter-term deposit or longer-term deposit? Think how banks think, if you can, or just read Chapter 4 and find out, are accounts that are in short-term paying higher, or are the longer-term ones paying higher? And that will help you get the answer right for number 10. So really 10 pretty straightforward questions, really pretty easy, shouldn't be a struggle, shouldn't be a challenge. You should be in great shape this week for the test. If you have any questions though or concerns as you listen to this recorded session, just zip me a quick text or email me, no problem. If you have any personal questions about tax for yourself or about banking, or cash management products, or what you're dealing with right now, you're welcome to text or email me as well, and we can kind of talk through things. I would encourage any of you who are willing to share on the discussion board this week feedback about your banking relationship, good, the bad, how that's gone, as well as issues of tax, who you use for tax, whether or not you use some software or go to the corner office guy or a CPA or do it yourself. I'd be interested to hear some feedback on that and get some things that you like about how you do it, things that you wish were better about the way that you do it. I think that'd be helpful. Those would be helpful discussion points this week on the board. Okay, have a great week. Good luck, and let me know if there's any questions or concerns, and we'll talk to you soon. Look for your grades and feedback on your grading here in the next 24 hours.